sole trader versus company structure. Now, I get this question a lot, but the gap in which you think that you need to switch into a company is a lot wider than what most people expect. So here I have a timeline of taxable income. So if you've got 100,000, 135,000, and 200,000, this is pretty much to show you guys what the differences are. So at 100,000 taxable income, now the reason I say taxable income, not profit, is because sometimes PTs work a full-time job and they're trying to grow their PT income at the same time. So I'm talking taxable income. So if you're only making 50 from your main job and 50 from coaching, then you would fall under the green, which is the 100,000 taxable income, even though you're only making 50K a year in your PT. So in the first example, the tax on as a sole trader structure on 100,000 is 22,788. The tax, the company tax rate on 100,000 is 25,000 because it's a flat 25%. So in that first scenario, you're actually worse off 2.5 grand. So there's actually no point in swapping to a company structure and paying the company tax rate. Now the second one is the taxable income level of 135,000. There you can see the sole trader tax is $33,988 and the company tax is 25% at $33,750. So it's essentially the same. However, you got to pay more accounting fees. Your compliance costs doubles and triples if you go towards a company structure. So I would argue that you're actually worse off. There's no point switching there. And then at $200,000, let's look at the differences. You have your sole trader tax at $60,138 and the company tax at $50,000. Now, towards 180 to $200,000, that's probably where you start to have the conversation. Anything before that, you won't necessarily get punished because even at 130,000, 35,000, it's actually the same. Now, the only reason you would switch into a company structure is for two reasons. One is for tax, and if you look at the boxes at the bottom, one is for tax and one is for asset protection purposes. Now, asset protection purposes, depending on the type of work you're doing, then you might switch to a company earlier. So let's say you're an electrician, right? And you're only making $135,000 taxable income. So the tax is the same. However, you need it for the asset protection because let's say you go work in someone's house and that fuse box blows up. Well, now you're kind of liable to the damages. So that's why you want to move into a company structure because there's a level of protection. Yes, they'll have insurance as well, but you want to make sure that if anything goes wrong, then they can't come for your personal assets. So I'd say where you start to consider is 180 to 200,000 taxable income. And even then, as a sole trader, you don't have to make super contribution payments. So when you work a job and you work for an employer, they're liable for your super. However, as a sole trader, it's voluntary. So even I would argue even at 200,000 taxable income, you'd be better off making like a 10 or 15,000 super contribution so that you can claim that amount and also bring your taxable income down by the amount that you claim. So anything above that, I would seriously consider moving into a company structure. However, the 175 to 200, I would say is the no man's land where you could switch into a company, but you might not necessarily get punished that hard if you're able to play with expenses like the super contributions.